All right, so welcome everybody to today's webinar. I am your host, William Benatti, and I am joined by Mike Ruscica. Today is part one of a three-part series that Mike and I will be doing about the journey of investing in real estate. And today's webinar is going to be around true passive income. We welcome any questions, comments, or feedback that you guys might have. With that said, let's go ahead and jump into agenda. So we'll be doing some brief introductions. Many of you know us already, but for those of you who don't, we'll be doing that. We'll touch on our experience. We'll talk about the concept of making money while you sleep. We'll talk about retirement and how you can replace your income from your job. We'll talk about tenants and toilets, why you should trust a real estate professional, some of the benefits of note investing, how to invest in the JKAM fund, and then open it up to any questions and answers that you get, or questions that you guys might have. If you do have any questions between now and then, just pop up in the chat there, and we'll try to address those too as we go along. So for those of you that don't know me, I'm William Benatti. I grew up in Colorado. I got a degree in finance and real estate from Colorado State University. Right out of college, I got the Series 7, 66 in life and health, and spent 7 years in the banking and investments field. And then I transitioned into investing in real estate. This started out with wholesaling houses, then flipping houses, and then investing in mortgage debt. And while I was living in New York City in 2014, I got connected with Jack Krupe and ultimately joined his team to run his non-performing loans dispositions trade desk. I was there for 2 years, and then both Jack and I left to pivot and form the JKAM Diversified Real Estate Fund. My family and I currently live in Vail Valley in Colorado, which many of you may know of or visit from time to time. So if you're ever out this way, let me know. And that's it on me. So Mike, why don't you share with everybody sort of your story, your background?
Yeah, my name is Mike Ruscica. I started real estate investing in 1999 while I still had my job, and managed to quit my job in 2005. And did some regular old flipping until I came across this note business. And I met Jack very early on in my my note experience back in 2007 or 8, I think. He was actually working for my mentor, and he was on the other side of the trades. And we got to know each other a little bit later, and I know that he went on, to create some very interesting funds. And I've watched him and his progress over the years, and it's been fascinating to just to know where we both started out. And to see where we are today. It's been fantastic. I'm really excited to have you on this panel here today, so that you can share with some of my people. We both have kind of a combined audience here.
Yeah.
And I'm going to find this very informative for myself, because I am in the beginning stages of starting my first fund. And I was excited for myself and to have this opportunity to get a ground level view of what you guys have been up to and what you plan on doing in the future. So I really appreciate this opportunity today.
Absolutely. Yeah, I mean, there's definitely a lot of shared interests, the commonalities between, what Jack and I are doing right now and your audience, which I think there's a lot of synergies there. So thanks for sharing a little bit about your background there. So tell us more about the Note Conference and what's going on with you right now.
Sure. So As of now, this is October of 21, and we've had a very slow year and a half as far as purchasing our non-performing debt. The banks have kind of gone into quiet mode for the most part. A lot of the employees were working from home, and selling their non-performing debt was really not on their radar as priority. I think they spent a lot more time creating loans and PPP loans and getting through this pandemic. And so the non-performing note business, from our perspective, pretty much just dried up and stopped. Which means that I think that once they turn the faucets back on, it's going to be a very interesting show, because they've had 18 months of not selling. So not only with new borrowers defaulting, but with their old paper that they should have been working on for the last 18 months, they didn't have the opportunity to. So that's what we're looking forward to. I do teach note investing at noteconference.com. You could drop me an email at mike@noteconference.com. We can schedule a call if anybody wants to learn a little bit more about what we do. And that's about it.
Yeah, awesome. Thanks for sharing, Mike. Yeah, for anybody that's interested in that, I know Mike, you've been doing notes for a really long time, and you've seen it all basically. So if you're interested or looking for, learning more about the note business, he's a great resource for that. So why don't we jump into sort of the topic of today's webinar, which is passive income. So first, let's start with what is passive income? So passive income is used to define money being earned regularly with little or no effort on the part of the person receiving it. So you might have heard it called mailbox money as well. And it's also important to know that there are really three main categories of income. So there's actively earned income. So that's basically what you're doing. You're exchanging your time for money, just doing what you do for a living, your career or whatever. Passive income, aka mailbox money, and then portfolio income would be, like your stock or bond portfolio that may be producing income for you in the form of dividends or yield from bonds. And I like to use this quote from Warren Buffett because he's a pretty smart guy, I've heard. If you don't find a way to make money while you sleep, you will work until you die. And I think that resonates with me and hopefully with you guys as well. Another pretty influential guy that you guys probably know of, Tony Robbins. So success is doing what you want, when you want, where you want, with whom you want, and as much as you want. So, success is really subjective. Success for me might be very different than what success is for you. I personally view success in that I have, more time to spend with my family, more time to do the things that I enjoy doing, which is, outdoor stuff, skiing, fishing, hunting, hiking, golfing, all that kind of stuff. So I base my success on how much time I have to do those things. Mike, how do you view success?
Well, it started out for me saying, listen, I want to get out of bed whenever I want. That really was my focus. And then it just went, it got better and better from there. Once I figured out how I could just get out of bed when I want, I started to taper off doing things that I had to do. And just like on your list here, doing what you want, when you want. And then I started adding the travel to it, and that's where you want. Once I started getting that passive income coming in, it was really where I want. So I never saw this quote. Yeah. It's a good one. I like it.
Yeah. So you start to be able to do a lot of that stuff when you have financial freedom. And financial freedom, some might call that retirement. So retirement improves both health and life satisfaction. That's according to the National Bureau of Economic Research. A lot of people choose to do things that they love in retirement. You don't necessarily have to stop working. The work might just be different. You might be working for a nonprofit or doing community service or volunteering, something that you enjoy doing. 46% of people would retire immediately if they won the lottery. So you hear a lot of interesting stories about people who won the lottery and then kind of gone sideways. But anyways, 25% of people believe that they need at least $1 million to retire, and 55% plan to work in retirement. And those who plan to work in retirement, 35% of them list lack of retirement savings as a cause. So it's unfortunate that I think where we are as a nation and an economy, a lot of people do have to prolong retiring or continue to work, and then also when they do retire, also have to continue to work while they're retired from their full-time work. So that's unfortunate, and we're here to try to talk about some of the ways you can avoid doing that. So some of the reasons for retirement are they want to do 48% say they want to do other things, 45% actually reached a normal retirement age, and 14% didn't like the work. And then there's unanticipated or involuntary retirement, which most typically is a health problem, or they're caring for family members, or they're forced to retire because of lack of work. I would argue that 11% of lack of work doesn't seem to be an issue at the moment.
Lack of employees.
There's a lack of employees at the moment, so that number will probably change. So looking at forms of retirement savings, 54% comes from defined contribution pensions, 48% comes from savings not in retirement accounts, 33% comes from IRAs, 21% comes from defined benefit pensions, 12 is other retirement savings, 9 is business or real estate, and 26% is none. So that none number is kind of scary. And then that top percentage of 54% defined contribution pension, I'm seeing a lot of pensions. I'm from a different generation than you are, Mike, but your generation, or say 40, 50 years ago, pensions were a lot more common among employers. My grandfather's a great example. He worked for Frito-Lay for his whole career. It's probably like 40 plus years or something. Same employer, retired, had a pension. That was sort of the way it was. People are changing jobs every 2 to 3 years now, and a lot of employers don't even offer retirement plans or pensions. So
sure,
with
our generation gap, I speak about my father. You're speaking about your grandfather.
Yeah,
my father retired from the post office, and he had a nice retirement. But in the 70s, when they switched things over to say, you know what, retirement's on you now, the employee, you better get moving. And I come from a blue collar background, and I watched my worker friends who were employees never contribute to their 401k, and they're my age now, in their 60s, and they're in big trouble. And so luckily we're able to speak and help people that have made some of the right moves, and people that would bother to get on a webinar like this one today to increase their potential for retirement.
Yeah. Well, and the interesting thing too, Mike, is that, all that has changed, right? It's basically like on us to figure out
Absolutely.
what we're going to do. But, I didn't learn about it in school. I learned nothing about saving for retirement or the importance of saving for retirement in school. It's just not part of the curriculum. So
where'd you get it from?
Experience.
Okay.
I got the Series 766 in life and health, and went to work for a bank and was a financial advisor. So I developed all those skills through my profession, and then even during that process, one of the reasons I'm not a financial advisor anymore is I didn't believe 100% in that process and those products and services available. And then a lot of it is, primarily just experience, right? So I started investing in real estate and was like, wow, there's a whole nother world.
Nice.
That I didn't even know of, that just opened up.
Nice.
So
it's good to see the young people active in this stuff.
Yeah. So looking at median retirement account balance by age. So this is also a pretty scary looking figures here. So 55 to 64 is 120,000, 45 to 54 is 90,000, and 35 to 44 is 51,000. So if I was 64 years old and had $120,000 in my 401k, I would have to change a lot to be able to retire. I would, certainly wouldn't be able to live here in Colorado. That account balance would be depleted very quickly. So, and granted, not everywhere is as expensive as Colorado or the Northeast, but this is kind of alarming that's sort of the average account balance.
Yeah, I think that's kind of high in some cases.
Yeah.
Unfortunately, some of the folks that I grew up with.
So this is American retirees by age. So the bulk of people are 100% retired by age 80. And then you see it taper off here. Very few people have financial freedom or retirement before the age of 50. Fewer still in that 60 to 65 range. So that's pretty interesting.
That's an interesting chart.
Yeah, income among retirees. This breaks down, where retirees are getting their income from. And so Social Security makes up a lot of it. Pension, also interest, dividends, or rental income.
These are percentages?
Yeah. So 93% is Social Security for retirees age 65
Wow.
and older. And there's been, one thing I will say is that I've always heard or people have been talking about for years, part of my generation, is that Social Security might not even be, we might not even see any money from Social Security, because they're running at a deficit and it might not be fully funded by the time we retire. So, but largely, most people are reliant on Social Security. And then part-time jobs. So while wages, salaries, or self-employment, and then cash transfers other than Social Security. So I'm assuming that they're talking about maybe family money or estate money in that scenario, or something like that. So why real estate? So real estate provides passive income. So real estate is a preferred choice for investors seeking passive income and cash flow that is paid monthly from tenants. An investor with monthly or quarterly cash flow is creating a new income stream that may protect that investor if they're fired from their job or lose their main source of income. So being a
That was me
landlord.
the other day.
Oh yeah, that was you.
Pretty similar.
That ain't me. So yeah, passive is definitely no tenants and toilets. So being a landlord or an owner of real estate means you have to manage the property or pay someone to manage the property. So passive is not being a landlord, and tenants and toilets, that would be active. So benefits of investing in notes. Yeah. Mike, why don't you take this one? Because you're in it right now. You've been in it forever. I think you could talk
Sure.
for days about this, right?
Yeah, for the last 14 years or so. So you've got here buying real estate debt at a major discount. It's all about the discount. We're buying loans. We just closed on some loans last week, 2 weeks ago. We bought debt at 30, I think we were in at 33 cents on the dollar, meaning I buy a $100,000 mortgage for $33,000. The borrower owes me $100,000, and it's that discount that we can profit handsomely from, and also pass on some of that discount to the borrower, and it works out really well.
So is that a first lien or a second lien, Mike?
We bought 3 second liens.
3.
Yeah, at 33 cents on the dollar. It was a $250,000 balance. We ended up, I think, at about $50,000. So it's all about that discount, and the banks don't want that headache on their books anymore. They know that we're serious. They know that we handle the borrowers correctly. We've got a track record with buying from this one particular bank, and we've had one source of product. That one source of product alone has been giving us stuff for 6 years. So you're buying debt from banks, hedge funds, other investors at reasonably low prices. So in my mind, we could buy those loans at 30 cents on the dollar, turn around and sell them at 45 cents on the dollar, and not even have to work them. So there's that side of the business too. But the passive cash flow comes from taking, let's use those 3 notes, and working on those 3, getting them performing, and then go on and move on to the next 3 notes and the next 3 notes. And if you do, if you want to keep it small and you do 3 notes a month or 3 notes every 6 months, after 3 years, this portfolio builds, this cash flow builds, and it really is making money while you sleep. I don't even have to be alive. And that cash flow, they don't know if the mortgage owner is dead or not. And gives me a lot of security for knowing that I've got these performing loans. They go on and on forever. I've taught my family this business so that they can go on and on, even after I'm not with them anymore. So that's the type of cash flow that I enjoy. There's all kinds of different truly passive cash flows out there. And note investing is just one of them.
And sorry to interrupt you there, but within note investing, I mean, there's so many different ways that you can participate in that business. I think one of the reasons why I transitioned from wholesaling and flipping houses into the mortgage debt space was, number one, it was less active, right? Like, so with wholesaling, like I would send out direct mail to owners, like have to field all these phone calls and then have to do site visits and then make offers and just do like a lot of work. And it wasn't necessarily as easily scaled And then I found out about, oh, geez, you could buy mortgage debt. I had no idea that you could be the bank, that you could actually buy mortgage debt.
Oh yeah.
And then
Nice.
that just like opened up a whole new world for me, and like, why, this is scalable. The spreads can be huge. It's, if you got a portfolio of performing loans, like you're talking about a little bit there, how you're working through, you acquire them, you get them reperforming, and then you basically have reoccurring income from that. That was all just like mind-blowing to me at the time. This was probably back in 2013. And there's just like a ton of different exits and scenarios, and the note space, like there's a lot of different ways that you can participate in that business. One of the questions that we have is from Michael Rogers, asking if you, Mike, can walk us through, at a high level, how you 10x your money using your self-directed IRA and buy non-performing loans.
Sure. So with my self-directed IRA, I actually opened up a trust inside of my IRA. Essentially, my IRA invested in this trust, and in this trust I started purchasing non-performing debt, and I got one borrower to give us a full payoff, $28,000. Now this was an $11,000 investment that I made just as a case study. At the time, I didn't know that it was going to be a case study, but looking back 3.5 years later, I'm like, well, this is going to make a pretty good case study. So that $11,000 investment, I bought 2 loans with it. One of them paid off, and that was a $28,000 hit. With that 28, I bought 4 more loans. Got those to pay off. I got some of them to turn into performing loans. I took the performing loans and I sold those to another passive investor who wanted 5 years worth of cash flow. I took 5 years of cash flow and gave that investor a 6% return. And for 5 years, they were going to collect that money for 5 years. And in the meantime, I took that $30,000. I went out and bought 4 more notes. And I got this thing up to, I think we're about $850,000 right now in cash and non-performing debt, meaning that debt, some percentage of the non-performing debt will turn into cash. And we just don't know exactly how much, but sometimes we offer discounted payoffs to borrowers. So out of the portion that is non-performing debt, we will get some percentage of that because it is guaranteed by real estate, and it is secured by real estate. So that's just one case study of it's not truly passive, but this is my retirement I'm working on, and I take it very seriously, and I think everybody should. I think that's why people are on listening to this recording today, is because maybe they haven't yet taken their retirement seriously, but they may want to start now.
Mike, thanks for sharing. How many years did it take you to get there?
That I opened that up in 2017, kind of as a dare. Mm-hmm. Let's see what we can do with this. And it was a leftover investment of $11,000 that I had. And I opened up, the first time I ever opened up a trust, that was it. That was a trust inside my IRA. My IRA contributed to that. That was in March of 2017. And it's now October of 21. So 4 years.
Yeah, that's pretty good.
And it was fun.
Yeah.
I didn't have to go up one ladder.
Yeah. That's the nice thing about the note business is the majority of it can be done at your desk or over the phone.
Or on the beach.
Or on the beach. Right. because you're using third parties to do a lot of the heavy lifting for you, right? I mean,
you have to. Yeah, with your self-directed IRA, you want to have these transactions completely at an arm's length, and you're really not allowed to get your hands dirty with these things. So we're hiring lawyers and servicing companies and everyone to do the work for us. We're guiding them how you want the deal structured, but you're not actually structuring the deal. You're letting these arm-length transactors structure the actual paperwork.
So
and I have an invoice.
You're working as a project manager, essentially managing the servicer of the loan, managing attorneys, managing real estate agents who might have be listing a property for you. So there's a lot of third parties, and teamwork to make the dream work. Basically, real estate investing is certainly a team sport. So there's a follow-up question there from Mike. Why did you set up a trust within your SDRA? Why not buy the notes directly?
So when you buy notes directly into your self-directed IRA through your custodian, the note actually, the way the borrowers, let's say you get a borrower to start performing, the borrower would actually have to make the check out to my IRA. So it would say, for the benefit of Michael Ruscica Equity Trust, or whoever my custodian is, pay to the order of, with my account number. And that's one bad issue with buying directly into your custodian. The second, and this is even more powerful, is having checkbook control. I have checkbook control of my trust, and I can walk around with the check. We're going to a note event in November. I'll bring some checks with me from that trust. Hopefully I'll meet a guy like Will who's got some notes he can sell me, and I can take out my checkbook and buy them right there on the spot, without getting permission from my custodian, without them having to see the collateral files or any of the roadblocks that we see. I just didn't know that these things existed, and that's why I teach this business, is because I want to help people get jump started and use the tools that I've been figuring out for 15 years to get them moving in the right direction in 1 year.
Yeah. Awesome. So looking at number 3 there, as one of the benefits, it's profitable in market cycles. So mortgage debt is definitely in a transitionary cycle right now, in that, there's relatively limited product available, versus, in post 2008, 2009, there was a significant amount of product available. I mean, tons, and that lasted all the way up until, in my experience at the volume that we were doing at the last fund, 2016, 2017, and it's gotten a lot thinner now. But as part of that cycle, the other side of that is what we're experiencing right now is a run up in home values. So if you are an owner of mortgage debt, borrowers are paying that debt. They're a lot happier and willing to pay that debt because they're not underwater anymore, or they can refinance and completely pay off your mortgage. So we're kind of on the other side of the cycle right now. And Mike, you talked a little bit, when we first jumped on here about, potentially seeing more product in the coming months and years. Sure. So, you're able to really play the cycle from both sides with notes. I got my hands on a stock prospectus from a pretty large bank, and
I was just flipping through it. I was just a random read, and I'm like, I wonder if they have a provision in this here for default rate. And so there it was on page 79. They had automatically built in a 4%. They calculate a 4% default rate on all the product that they create. And so that's just a normal number for them. Yeah. Whether it's 3 or it's 5, I'm sure it's going to fluctuate a little bit, but they just build into their model, just like a store would build into their model a certain amount of shoplifting, let's say. So they know that 4% of their product is going to get stolen. So they have to build that into their pricing. And just like this stock prospectus builds in to their telling their investors, hey, we may see a 4% default rate this year. And so far with COVID and with it's been more like 9%. So it's more than doubled. But my point here is not about COVID. My point is there's always a default rate. There are always defaulted mortgages. It does not have to come from hardship or anything. Sometimes, people die, things happen, and they default on their mortgages. And there's people like us who have connections with banks. We've got a good reputation, and we get to see the product. So, yeah. But you're true. It's serious cycles going on right now. But I think it's kind of hand in hand. We've got real estate going up, and we still have these defaults. So we are in definitely interesting times. I can clearly say that.
And so the number 4 there is multiple options for profitable investment exit. So could you just maybe share with the audience a few of the ways that you could profitably exit a note?
So like what we're seeing right now, we're seeing, like we had mentioned before, equity has gone up on these properties, and refinancing, there's so much available cash right now from refinances, and then there's the option of people selling their house. And because I'm on title, meaning I have a recorded assignment at the county courthouse, and when it comes time for the sale of a property, the title company will go and search out all the mortgages and all the debt that's attached to that house, and we get a phone call. We put our 800 number on the assignment, and we get a phone call and say, hey, we need a payoff for this property at 123 Main Street. So I go to my computer, I hit print screen, and I send off a payoff letter, and we get paid. So there's home sales, we get paid. There's refinancing, we get paid. There is workouts where we can forgive some of the arrears or some of the debt and get a chunk up front, and then we get monthly payments going out for the next 20 or 30 years. Sometimes we had to foreclose to get the borrower to wake up to the fact that we are real and that we will foreclose if we have to. And that's an exit as well for us to get to some type of a resolution. Yeah. I mean, guys, and that's just a few of them, right? Those are the most common, but those are 4 of the most common.
There's so many ways that you can find a profitable exit from notes.
Yeah, I could sell these notes to Will and profit.
Yeah, I like performing notes, but I need a big discount. I'm going to need a nice
you're not my guy.
Right? Come on.
You're not my guy.
So, and then the last one there is win-win deals for borrowers and investors. I think one of the things that compelled me to be participating in the mortgage debt space when I first entered it was, wow, I can buy this debt and find a solution that yields a great profit or return for myself and my investors, but also benefits the homeowner. Again, just mind blown. Like, and an example of that would be when I first entered the space, you could buy a first lien non-performing loan for between 40 and 50% of the property value. So, for example, let's say the property value is worth $100,000. I could buy the debt, which most of them were underwater at that time, so the debt might have been $150,000, and unpaid balance might have been $150,000. But I was buying that mortgage for $40,000. And so, like, one of the first things that I would do when I, took possession of that mortgage note and assignment was do some borrower outreach and say, how can we help get you back on track here? Do we need to, does it make sense to take this out over a longer term? Can we do a unpaid balance reduction? I mean, because I just paid $40,000 for $150,000 worth of debt, property value is 100. Like, I could knock off $50,000 in debt and not really have it impact, my profit in a, substantial way. So just a basic example of how, note investing could be a win-win for the borrower and the investors.
Yeah, it's actually a win-win-win. The bank wins because they get it off their books.
Right.
We win because of the potential of the profit. And then, like you said, the borrowers, we pass that on to the borrowers, and it is a beautiful thing. And no one gets hurt.
Yeah. So it doesn't look like I've got any other questions on that particular topic right there, or the note space there. Mike, why don't you share a little bit about the note conference and what that can do?
Well, thank you. So like I said in the beginning, you can go to noteconference.com and check out the website. I also have a YouTube channel called Note Conference, all one word. And we teach what we just explained. We teach where to find these notes, how to find them, how to broker them, how to work them, what to look for in due diligence prior to purchase. The whole complete education package. And then we meet every other Thursday night on a live Zoom call. We get together and we tell our war stories. It's me on the call every other Thursday night, and we've got a full training recordings that we're constantly updating as things change in the market, things change in the laws, and Note Conference has been around for about 12 years now, and it started off by accident. I just like talking about the business, and I would hold a webinar every once in a while, and one guy said, you should come up with a topic every time you do a webinar. And then I started charging people to come on, and people started getting into it and doing deals together, and one thing went to another, and here we are.
Yeah. Great resource. So, if you guys are interested in learning more about the note space, check that out.
Thank you.
And so we'll talk a little bit now about Jack and I's fund, which is JKAM Diversified RE Fund. And so Jack and I, the last fund was all mortgage debt, and we have pivoted to starting a new fund, which, the purpose of the new fund was to provide diversification for accredited investors that is risk adverse, and then offers a great tax advantages and yield. So we primarily invest in multifamily value add type of projects. So these are projects that have current cash flow with an upside potential. That current cash flow comes from rents from the property. So most of the properties, well, all of the properties have a mid-90s or high 90s occupancy rate, and even collection rate through COVID, which was kind of surprising. And these properties are almost always 100+ unit buildings in strong secondary markets where we're seeing a lot of growth and a lot of migration to. So an example of that would be Atlanta, Jacksonville, Phoenix. And these properties are what are considered Class B. So there's really three major classes of property, A, B, and C. So A is like your new development, luxury type apartments. Class B is, below that, and then Class C is, low income housing. So Class B being in the middle is very resilient to economic cycles, in that, if there's a booming economy and everybody's doing well and doing great, people are rising out of Class C into Class B, and people are maybe moving out of Class B into Class A. And then vice versa, if there's a recession and people are struggling and there's hardships, people are moving out of Class A into Class B and out of Class B into Class C. So Class B being in the middle, there is demand for that type of housing regardless of the economic cycle. So that's one of the reasons that we absolutely love Class B. And so what we do with these is they're repositioned multifamily housing through renovation and improvements. So they're typically 20, 30-year-old buildings that need updated countertops, kitchen, cabinetry, bathrooms, carpet, and paint, right? So between $3,000 and $6,000 a unit. And by doing that, we're and then also updating amenities like community space, pools, workout rooms, outdoor space. And by doing that, we're able to raise the rental rates between 3 and 5% per year. Or for an example, maybe $75 to $150 per unit. And when you do that on properties that have 100+ units, you see a pretty significant increase in the net operating income, or the value of the building.
Nice.
So that's the that makes up at least 75% of our funds allocation is into properties like this. Again, because they have got current cash flow, upside potential. So when you increase the value or you increase the net operating income, you can resell or sell that building at a pretty significant profit. And then another thing that's not on here, that's another major reason why we really like multifamily, is the tax advantages. So you can we do cost segregation studies on the properties to basically accelerate depreciation. And so when we're making upgrades to cabinetry and appliances and things like that, a lot of that can be depreciated in the first couple of years. And so and we pass that depreciation through to the investors in our fund. So if you've got, other passive income, if you look at your tax returns and you see on schedule, I believe it's Schedule E, that you've got income or passive income there, a lot of that can be offset with the depreciation from our fund. So that is why we like multifamily. And so the Diversified Real Estate Fund, the JKAM fund, allows passive investors to invest alongside our firm into alternative investment opportunities. And these opportunities are typically off-market and difficult to access through traditional wealth management channels. So no financial advisor is going to recommend this because they don't get paid on it. They'll sell you an annuity instead. The benefits are you get diversified real estate investments across multiple markets and developers. You have access to proprietary off-market deal flow. And as I just talked about briefly there, it's tax advantage. So we pass through depreciation. So more on the access to proprietary off-market deal flow. So a lot of the projects that we are investing in, they're typically oversubscribed. So if you wanted to invest in that directly yourself, let's say you knew the operator of the project and you wanted to invest in it, it's possible that you could, but it's likely that you couldn't, in that they want to partner with us because we can consistently be a larger check writer for them, not just on one project, but on a longer term basis. So the next project, or on all the projects that they do for that matter. So a lot of these are not publicly marketed or available, so that's what we mean by off-market deal flow. A lot of these projects and opportunities, like as a non-active real estate investor, like you would never see them. So
yeah, it's kind of like the note business, with the connections that you have with the bank. It's kind of I don't know, but it's just
right,
not for
Mike.
everybody.
And how long did it take you to develop those connections with the bank?
We're doing it to this day. We're building that relationship to this day. 15 years now.
Yeah.
And just to be clear, this webinar here today is not the purpose of this webinar. Really is, I've got a lot of people in my camp that are really interested in how other people are building their fund, and to be able to witness this today. This is not a capital raising webinar. We're on this thing. Will and I are on this thing to show the ins and outs of the back end of owning a fund, and I just wanted to make that clear.
Yeah, thanks for sharing that, Mike. So, why would you want to participate with JKAM? And from a passive standpoint, the reasons are we have the experience and expertise. Jack and I's experience is 20 plus years. You get diversification. So you get diversification across sponsors, geographies, and asset classes with a combination of current cash flow and upside. And then the third there is JKAM often invests as a co-GP in these projects. So as I briefly mentioned there previously, you might be able to invest in a similar type of project to what we're doing, but you likely wouldn't get preferential terms like we're getting because of the strategic partnerships that we have with these operators of these projects. So those are some of the main reasons why you would want to participate with us. And then looking at, sort of the outlook for the fund. So we are primarily investing in multifamily. We'll look at self-storage, although we haven't seen anything that attractive. We do have one senior housing development project, a small allocation into that, and private lending. So we did a trade at the end of last year. Mike, I was telling you a little bit about this when we first jumped on. It was about 26 loans, and we basically have 10 performing loans remaining from that trade and have sold the rest of those. And I think we got about 95% of our capital back from that, and from that trade, and then still have 10 performing loans. Nice.
And those are single family residential?
Yeah, single family residential.
Nice.
And so that, that also makes up a small portion of the fund. But primarily we like multifamily. Total raise, so we set this as a 15 million raise. We're going to be closing this fund likely by year end. Minimum investment's 50,000. The cash on cash return, or basically the quarter or the annual preferred that you would get, is 6 to 8%. The 8 is for 250,000 or more. And the target IRR, so the IRR is total return annualized is 15% plus. We're trending higher than that, and we'll likely end up higher than that. So that's kind of our conservative numbers there. So if you want to learn more about the JKAM fund or JKAM investments, you can go to jkaminvestments.com/offerings, see what we have allocated currently in the fund. You can read our private placement memorandum, our subscription agreement, Jack and I's bios, basically everything you need to know. There's also a ton of content on our webinar. So we do a ton of content on our websites. We try to do webinars bi-weekly, from an educational standpoint, to just try to make more people aware of this as an option. Kind of like what we're doing right now or today is talking about, passive income through real estate. And so, and I know, Mike, you got all those. Do you have to participate in the Note conference to see your content, or how would people be able to view a lot of that as well?
For my stuff?
Yeah.
Well, yeah, I've got so much stuff on YouTube for free. I think everybody gets a kick out of seeing the progression. I've got videos up there from 10 years ago, and people can progressively watch me age on YouTube. And I know I get a kick every once in a while. I'm like, oh my God, look at that. I haven't. But we actually have some free videos that you can get to from noteconference.com as far as the education stuff. And the thing that I like is when people go ahead and they want to schedule a call with me, I end up talking to people for more like an hour instead of 15 minutes that it says on the website.
Yeah.
But I love talking about the note business. I find it very rewarding to watch my students, even so, like a webinar like this, they get to see a fund. So it gives them vision for, let's say, 2 years down the road, where they work in a blue collar job, and then they come across me, and then because they come across me, then they come across you, and then they go to your website and they're like, oh, I see how they do this now. And they've got a form that they have to fill out, and they need to be an accredited investor, and then that form will take them to a different thing. This is a whole nother world that I never knew existed. I go to work, I get my paycheck, I blow my paycheck, and I got to go back to work. And that was my life. But then this whole other, hey, why don't I just partner up with somebody or a couple of people, and let's start a fund, and let's get good at whatever we do. Let's get good at buying apartment buildings and doing all the front calculations to make sure that we're actually going to make money for ourselves and for the people that we bring into the fund. And let's get really good at something and start my own fund. It's like, let's do that. And then let's go to San Juan, Puerto Rico, because we can run the fund from San Juan, which sounds really awesome. If you've never been to Puerto Rico, I advise you get there. The place is amazing. I've done quite a few deals from the shores of Puerto Rico myself, with my cell phone and my laptop. This whole world we're opening up this whole world for other people to see. And I really appreciate Will and Jack too, when I see them, for this opportunity for my people to see what the heck is going on behind the scenes. I love it. Yeah.
So the backstory on, have you met up with Jack in Puerto Rico since he moved down there?
No.
Yeah.
No.
So the backstory, or one of the main drivers for Jack relocating to Puerto Rico is the Tax Act. So for those of you not familiar with it, if you spend, I think it's 185 days established residency in Puerto Rico, you can save a significant amount in taxes. You know, in New York City, you're paying almost 50% in taxes. And if you move to Puerto Rico, I think it's like 4%.
4 to 6.
4 to 6.
That's state and federal. I mean, that's the whole ball of wax. 6%. Crazy.
Yeah. So that's why Jack is in Puerto Rico. He does keep a place in New Jersey, so he's back in the States, and he's actually, I think, out in Las Vegas right now. So, Mike, I had a question for you. It doesn't look like we got any additional questions at this moment, but for those of you listening, if you got a question, go ahead and ask that now. But I'll start it out. So if I am looking to invest passively and I'm interested in the note in mortgage debt, like what's the best way for me to do that?
Well, for me right now, like I said, we are starting a fund, and we'll have a lot of new information on that coming up. So I really would say to go to noconference.com and put your name and email address on the front page of the website. And what I do is I send out periodic newsletters where I'll just ramble on about something like I had a note deal today in Louisiana where the borrower actually completed and made all their payments through Chapter 13 bankruptcy, which I know you love. Love.
So good.
You could start a whole fund around Chapter 13. Is that what you did?
Well, that's what Jack did. Yeah.
That's what Jack did.
And so, it just wasn't it was bankruptcy, so that included Chapter 7 and
7 and 13. That's my world too.
But anyway, is in the 13s.
Yeah. So this borrower completed all the payments, and then we went to record the satisfaction in Louisiana. I don't know if you're familiar with it, but there was something, and I overheard it in the office, where it's the only state where you have to record the note and mortgage in the satisfaction. We didn't know that, and learning every day. So I'm definitely. So anyway, if you put your name and email address on the front page of my website, we'll keep you up to date on all of our fund activity. If you want to get more involved, go ahead and schedule a call with me, and we'll get you set up with the education. If you want to do it completely passively, my life is so passive now with the performing loans and stuff. I really think that if you take the time to learn the business, so let's use you, Will. I know you've got to get going, but you learned the note business, and now you're in the apartment business. But if some notes come along, you buy them, and so you're an expert in at least 2 fields now. Mm-hmm. And the way I see that, and it's funny the way you told that story, where you can just bounce back and forth and do both. I'll never not be in this non-performing note space. I'll never not be in it. It's the most fantastic thing that I've ever come across. And yeah, I could get into apartment. I own some multifamily property, and I thought about taking that up a notch, but if I can bounce around and do both, it's an awesome thing that you got going on. I love it.
Yeah.
Yeah.
All right. Well, thanks for sharing that, Mike. Doesn't look like we have any at the moment. This is recorded, so you guys will be able to watch it later. If questions pop up or arise, you have our contact information there. Shoot us an email. Happy to jump on the call. And like Mike said, 15-minute call will probably turn into an hour-long call. So
whether you like it or not.
Yeah. I mean, we could just talk for days.
That's it.
But At any rate, we are also, so this was part one of a 3-part series. We'll have another webinar that you guys can register,
Awesome.
Register for. I believe that one is in 2 weeks. So
looking forward to it.
Yep. So that's all for today, guys. Mike, thanks for joining us today.
Hey, cheers, man. Good luck to your group here. I love it.
Yeah, we'll see you on the next one.
Bye-bye.
Okay, see you guys.